You've probably heard that it's smart to draw down your RRSPs early in retirement, right? Smooth your tax bill and hopefully avoid a big hit later on. But is that always the right move? What if accelerating your withdrawals, what us planners sometimes call a RRIF meltdown, ends up actually costing you more than it saves? In today's video, I'm going to show you a case where two different retirement plans built for the same couple with the same lifestyle and the same investments result in wildly different outcomes. One plan prepays the tax early to avoid an estate tax bill later. The other one just lets things ride. And by the time we get to age 95, the difference in after-tax estate value is nearly $500,000. Hey there, I'm Steve Willems, a certified financial planner and wealth advisor with the Willems Wealth Planning Group out here in BC. On this channel, we help Canadians plan smarter retirements, reduce taxes, and make better decisions in the years that matter most. So let's dive in. But before we get to the numbers, let me just quickly set the stage. So when you retire in Canada with a decent sized RSP or RRIF account, whether you realize it or not, you're sitting on a future tax liability. It's what we call a tax deferred account. The money inside that account isn't taxed yet, but it will be taxed when you take it out, either when you're alive or on the day that you pass. So one strategy you'll often hear about is what's called the RRIF Meltdown, which is where you're going to be withdrawing a little bit more from your RSP or your RRIF account earlier in retirement on purpose to spread out the tax bill and to avoid a giant tax bomb later on when you pass away and the whole thing becomes taxable all at once. And in many cases, this does work beautifully, but not always. Sometimes drawing more now just to avoid tax later can shrink your investment base so much that you lose out on years of tax-deferred growth, especially if you live a long life. So in this video, we're going to look at two different scenarios for a couple, and we're going to stress test the differences between letting their RRIF ride and melting it down early. What we're really asking here is, when is prepaying tax a smart move and when does it backfire? And so on this channel, we try to show, not tell. So let's use a case study to test out this question. So let me introduce you to our case study couple, Mr. and Mrs. RRIF Meltdown. Great name. They're both 65. They recently retired and they're looking to keep things simple. Their mortgage is paid off. They'll receive full OAS. They've lived in Canada their whole life and they'll get a partial amount of CPP. Their goal is to spend about $7,000 a month gross, or $84,000 a year, to fund a modest and comfortable retirement. Their total savings is about $1.6 million. All of that, again, for simplicity purposes, we're going to say is entirely inside their RRSPs, which have just been converted over to a RRIF. We're going to be splitting the income between the two of them for income splitting purposes. They've got no TFSAs. They have no non-registered accounts built up yet, but those may come into play later on depending on how the plan plays out. So again, what's the big question that we're trying to answer? Like, should they just draw what they need to from their RRIFs every single year and they let the rest grow and compound? Or should they accelerate those RRIF withdrawals early, pay a little bit more tax now, but potentially save on estate taxes later? Like, what's the right move and how will we tell? So to answer that, we tested these two plans. The same couple, same retirement spending, exact same starting point. No funny business. So let's walk through the first one. So in plan one, Mr. and Mrs. RRIF Meltdown will do what most people do by default, right? They're just going to draw what they need from their RRIFs, about $7,000 a month gross in their case, and they're going to leave the rest of it to grow. Now, they're not going to trigger any extra withdrawals. In this plan, they don't need to prepay the tax unnecessarily. Their mindset is simple. Why pay the tax now when you don't need to? And in the early years, this plan feels great, right? Like, fewer withdrawals mean less taxable income, and that keeps their tax bill low. And when we model this out, we can see right here their taxable income over time. We can see here their RRIF draws, and we can see here an annual kind of like expected tax return based on all of this. But of course, they're not avoiding tax, they're just delaying it. And so what does this look like over the long run? Well, here's what we see when we test it. If we add up the total amount of taxes paid up to their age 85, it's going to total about $344,000. Their net worth pre-tax at age 85 is going to be about $1.7 million. But let's remember that if they both pass at the age of 85, their estate will have a tax bill to pay, and that'll reduce how much is left over for their beneficiaries. That amount left over after those estate taxes have been paid looks like it's going to total just over $1 million. If we stretch this out a little bit further and we have the second of them living till age 95, we see their living net worth actually decreases to $1.41 million, down from $1.7 million. And if we look at this from an after-tax basis, the exact same age, again at 95, that's going to be a total of $1.17 million versus $1.05 million. So again, early on, it looks like they're winning, right? Taxes are low, the portfolio compounds, the living net worth stays strong. But by the end of the plan, we see this really big tax liability. Why? Well, because everything is left still in the RRIF, which is fully taxable on their death. And so when Mr. RRIF Meltdown dies, and eventually Mrs. RRIF Meltdown dies too, that big remaining account balance is going to get taxed at the top marginal tax rate, potentially over 50%. And so this is the tax bomb that we often talk about all the time in retirement planning. So while this plan feels tax efficient in the short term, it does come with this big catch later on. Their estate is going to take a big hit, and any opportunity to shift income into lower tax brackets earlier in retirement has been missed. But to be fair, this strategy does leave more money in their hands while they're alive. Their living net worth stays higher for longer, and that's a very real advantage, right? If they prioritize lifestyle flexibility or longevity planning. Now, before we jump into plan number 2 and test what happens if they take the opposite approach, if you find this kind of content is helping you kind of make sense of your own retirement strategy, I just suggest maybe consider subscribing. We break down these kinds of real numbers and kind of real trade-offs on this channel every single week. We'd love to have you join us next week too. So in plan 2, we're going to flip the script. Instead of drawing just what they need, Mr. and Mrs. RRIF Meltdown are going to decide to take out more from their RRIFs earlier. Roughly $10,000 a month is what we'll test at here. And that's going to bring their total income close to the OAS clawback threshold. Now, here's an important point. I'm not going to actually have them spend that extra draw. What I'm going to have them do is reinvest it. Again, this video isn't about getting them more retirement spending. It's about testing an identical amount of spending for 2 different tax outcomes. And so with that excess savings, first we're going to direct it into their TFSAs, and then when those are full, we're going to direct it into their non-registered accounts if it's still needed. The idea here is simple. Pay a little bit more tax now to hopefully avoid a big tax bill later. And so this is what's often called a RRIF meltdown strategy, deliberately drawing down your registered accounts earlier in retirement while you still are in relatively low tax brackets to hopefully reduce the future estate tax exposure. But does it work? Well, let's take a look at the numbers. So compared to plan number 1, here's what changes. The total taxes paid out to age 85 is going to be about $585,000. Now that's $241,000 more than in plan 1. That makes sense. In this plan, we're choosing to prepay some of that personal tax. It makes sense that we're going to pay more tax by the age of 85. Now, net worth at 85 is going to be $1.19 million. This is wild. That's $598,000 lower than plan 1. And that's pretty interesting, right? This is no small amount. That's a much smaller pre-tax balance sheet, far fewer assets than plan 1. But here's the twist. The after-tax estate value at the age of 85 is $1.19 million also, $34,000 higher than plan 1. So we already can see the trade-off, right? Like more tax paid earlier, which shrinks the portfolio, but it also reduces the tax liability later, nudging the estate value higher in the midterm, right here at age 85. But what about the long game, right? There's decent odds that one of the 2 of them are going to live into their 90s. So again, let's look at this where the last of them passes at the age of 95. So by 95, their living net worth is down to $854,000 compared to $1.41 million in plan 1. And the after-tax estate value, also about $854,000, which is $468,000 less than the slower withdrawal strategy. This is pretty wild. So what are the takeaways here? Well, in the short term, this strategy does improve how much money is available for their estate. But, and this is a big but, if Mr. and Mrs. RRIF Meltdown live a long time, the lost compounding from the early withdrawals does start to drag. That good decision turns into a bit of a regret. you're left with a smaller asset base and it becomes harder to catch up. This plan reduces the tax bomb for sure, but it also comes at the cost of prepaying taxes and shrinking your financial cushion in the later years. And that's the heart of this trade-off, right? Like, do you want more certainty for your heirs, or do you want more flexibility for yourself? And neither is wrong, but the implications are pretty real. So if one strategy leaves you with a big estate tax bill and the other one slowly drains your financial cushion, is there perhaps a smarter path? Well, in many cases, yes. It's probably going to look like a blend of both of these. So instead of going full throttle with either approach, you're going to take a middle path. You're going to withdraw a bit from your RRIFs early on, enough to smooth out your taxes over time, but not so much that you lose out of that long-term growth. You're going to use those extra funds to top up your TFSA or build a small non-registered cushion, right? Like a sleeve of flex cash to help you absorb lumpy expenses down the road. Then you're going to keep your lifestyle spending steady without locking yourself into kind of a tax-heavy future or draining down your portfolio too soon. So we see this hybrid approach work really well for couples who want both tax efficiency and flexibility. It might not minimize every number on the spreadsheet, but often it does avoid the regret of going too far in either direction. So what's the takeaway? Well, RRIF meltdown strategies can absolutely reduce future taxes, but they come at a cost. You're prepaying tax, which means less money growing for you during a really long retirement. And so the right answer, like with almost everything, it depends on what you care the most about. If you're trying to maximize your estate, early withdrawals might help. If you're focused on flexibility while you're alive, letting that RRIF ride might make more sense. And for a lot of people, a balanced approach, right? Some early withdrawals, but not too aggressive, strikes the right middle ground. If you're not sure which side your plan should lean on or whether this even fits into your goals, we'd be happy to help. Every week we set aside time for us to chat with folks who've got good questions about this type of stuff. We'd be happy to lend a hand. But hey, that's all for now. Thanks for watching. I'll see you in the next video.